What's up, traders and investors, and welcome back to the Trading Analysis YouTube channel. It's Bennett Tyndall here with you on Tuesday afternoon. It's September 6th, 2022. Summer is officially over. We're here to talk about WTI crude oil, taking a quick look at the weekly chart, which we published last month in an email talking about WTI crude oil and the energy sector. And this pattern development, this chart development, is approaching a make or break zone that will either set us up for an upside reversal towards the 130 handle March area high, or alternatively, it's going to set us up for a break to the downside, which would suggest the top in the energy sector could in fact be upon us. So let's discuss it. Let's get into it. Let's talk about the pattern, and then we will of course look at the XLE wave count as well. So here we can see a weekly chart of WTI crude oil going back to the November 2nd, 2020 low, where we can source an uptrend support line, which is then confirmed through November of 21. And as you can see here, we now have a confluence of both the 50-week moving average in blue, the orange uptrend support line from November of 20 through November of 21, and more importantly, the equality projection of the March decline. In the world of Elliott wave and corrective trends, we will often see corrective legs of the same degree demonstrate equality to one another, and that equality guideline is demonstrated in either duration of correction or the magnitude of correction. Another key characteristic of an overall counter-trend corrective pullback is the fact that we often see corrections contained within parallel trend lines. And if we ask Motive Wave, the trading analysis addition to Motive Wave, to illustrate and outline the corrective trend channel, we can see that we now have a confluence of not only our equality projection, our 50-week moving average, and uptrend support, but also our corrective trend channel, which began back from and is sourced from the March high of this year. The corrective trend channel takes into consideration the high through the B wave with the parallel trend line over the low of the wave A position. And in this case, this looks to be very corrective, which is exactly what we saw unfold into November of 21. In this case, the ABC correction into November of 21 actually unfolded as a flat correction, where the B wave actually set a new high. And in the most recent ABC decline that we currently see for WTI crude oil, this most recent ABC decline is best counted as what's referred to as a zigzag. And for those of you who are unfamiliar with the world of Elliott wave, there are only three corrective patterns. There are variations of those corrective patterns, but the overall breakdown of a zigzag compared to a flat, and the only major difference would be that in the case of a flat, your A wave is decomposed as a three-wave subdivision, your B wave is a subdivision, or a three-wave subdivision that must retrace somewhere north of 88%, preferably north of 90% of the A wave decline, and sometimes, as you can see in the case of the October 24th, 21 area high, it actually set a new high and appeared to be uptrend resumption, but proved to be wave B of an ABC flat. And then we look for 5 waves down in C. In the case of the zigzag correction, we, instead of having a 3-wave subdivision off of the high, we end up with 5 waves down in the wave A position. We then look for somewhere between 50 to 78.6% as far as a retracement goes in wave B, and then more often than not, your C wave is going to be equal either in magnitude or duration compared to the A wave. So that's exactly what we have decomposed here in the case of WTI crude oil from the March area high. So let's delete that and now dive in. We'll move off of the weekly time frame, move lower in the time frame scale down to the 195-minute time frame. I'll go ahead and remove the moving average just to clean the chart up for you as we continue our discussion. And looking to the ABC correction that we have seen thus far from the March 130 handle area high, we can see a clear 5-wave decline in the wave A position. The 5-wave directional decline suggests that we should see a 3-wave retracement in the wave B position somewhere between 50 to 78.6% of the A-wave decline. And as you can see here, our 786 retracement did act as resistance, and as such since set us up for a C wave move to the downside. Now, if we measure the initial March decline and project it from the B wave high, we end up with our equality projection at 88.64. As you can see, every time we have met the equality projection near the 88 handle, we have seen sizable bounces back to the upside. In fact, the most recent being from the August 17th high into the August 30th high to the tune of nearly 14%. But we have since seen another directional decline. In addition to the equality projection of wave C compared to wave A, we also have the corrective trend channel in green. So when we put all of this together, we are offered support at the 50-week moving average, uptrend support from November of 20 through November of 21. We have our equality projection of C compared to wave A, and we also have our parallel trend channel. Now, at the beginning of the video, I suggested that WTI crude oil was approaching its make or break zone to either prove this pattern true or continue to move to the downside. And that zone appears to be upon us in what looks to be an ending diagonal for wave C of the contracting variety. Contracting variety diagonals have progressively shorter segments of the wave structure. So 3 is shorter than 1. 4 is a smaller percent retracement than 2, which you can see here. Wave 4 was 13.91% and wave 2 was 15.3%. So that tells us that our orange circle wave 5 needs to remain smaller in price compared to wave 3, and that equality projection of 5 compared to 3 comes in at 80.15. If we zoom in on the pattern for wave C, we will notice that we have a 5-wave move down and now 3 waves back that is beginning to turn lower. Now this B wave can meander further back to the upside. We could do a little 3-3-5 flat in the B wave and then ultimately move down in wave C. The bigger takeaway here for me as a technician and as an Elliottician is the idea that the next impulsive move to the downside, or I should say the next motive move to the downside, because the C wave can unfold as a motive diagonal instead of a motive impulsive trend. And that would suggest that wherever the B wave ends, the decline that follows needs to finish the ABC correction from the March high. This zone of support is going to come in from the wave 1 through 3 trend line, and we're also going to get support right at the corrective trend channel. More often than not, you will see an overthrow where you will have a breakdown under or above a channel resistance line. And in this case, that's exactly what I'm looking for here in the case of WTI crude oil. I'm expecting resistance in B between 90 and 93 to yield a move down towards, let's call it 80 to 83. In that 80 to 83 zone, we need to see our trend line from 1 through 3 respond, and we need to see the wave 5 complete before 80.15, and from there, we will need evidence of 5 waves back to the upside in order to suggest that this has been an ABC corrective trend. Now, it is worth acknowledging that going into, or I should say coming out of the December 21 low, our preferred view of WTI crude oil had us moving higher in a wave 5 position that we expected to be terminal. And what we mean by that is that we expected that to complete a major wave progression from the 2020 low, and this should then set us up for a larger correction or a larger retracement of this upside breakout. Now, the reason we opted to go ahead and modify the wave structure to allow for this to not be wave 5 was due to the fact that we saw WTI crude oil demonstrate a peak in relative strength in the wave 5 position for both the daily and weekly time frames. That is not typical of a wave 5 completion. That is more typical of wave 3, which is exactly where our more bullish wave count came from, which suggests this is simply an ABC correction before continuation back above 130 and potentially towards 146, the high from 2008. Now, obviously, we don't know the potential catalyst that could substantiate or support such a significant break higher, but from a technical perspective, it remains a possibility and something we need to continue to watch. If, in fact, we do not hold support, but instead break lower, we may have to consider the idea, as we discussed in August, that we do have a more significant Wave 5 completion in the case of the energy sector and crude oil. And that potential top, more significant top, is actually supported based on a historical comparison to the relative outperformance that the energy sector saw into the summer of 2011, which essentially marked the top of the crude oil market for better than a decade. We are seeing very similar conditions today where the energy sector has been in a period of outperformance and is beginning to see a momentum fade on the monthly time frame. Now, before we wrap this up, let's take a quick look at the energy sector wave count. And in the case of the energy sector wave count, our best view would suggest that the March area high, or I should say in this case the June high, as the energy sector continued to make highs into June, the June high would make wave 3 of higher degree wave 3, which means the pullback into July either marks the end of wave 4, or we are going to enter a more sideways period of consolidation, which is exactly as we have outlined over in our blue count. Our blue count would suggest that we have that same wave 4 position, but in this case, the wave 4 is going to consolidate further in either an ABCDE wave 4 triangle or just a simple ABC zigzag. If this is an ABC zigzag, the C wave can take us lower. But let's get off of the weekly time frame and let's talk moving you down to the daily and look at the zone of resistance that we most recently rejected. The zone of resistance that we most recently rejected in the case of the energy sector includes an equality projection of C compared to A, or said otherwise, the July 14th through July 29th rally projected from the August 4th low. That equality projection did have confluence with the 78.6% retracement of the June 8th through July 14th decline. And that is where we may have made wave B of a zigzag and we go down to make 5 down in C, or we just simply triangulate and then ultimately break higher. But very similar to the crude oil wave count, we see in this instance a peak in volume in the wave 3 of 3 position, and we also have a similar peak in relative strength in the wave 3 of 3 position on both the weekly and daily time frame. That would substantiate and at least help to support and acts as a confirming indicator that this is some sort of a wave 4 development. Now, what if wave 4 is over? Well, could we technically be doing 1-2, 1-2 out of wave 4? Yes, that remains a possibility, but one word of caution that I would have on this interpretation is the degree violation implications that are going to present if this wave 2 exceeds the magnitude of the parent wave. So what is the takeaway? Well, long story short, we have a very key pattern development at work in WTI crude oil. If the key pattern development in WTI crude oil holds and results in a pivot back and bid back to the upside, we have two ways to keep the uptrend alive in the energy sector. One which would say wave blue 4 of the intermediate degree is over and we're moving higher in 5, or we have further consolidation and then ultimately move back to the upside. And then if we do break down in WTI crude oil, we need to at least be aware of the possibility that we are up against a more sizable ABC correction. I just don't see it yet from a technical perspective. From a technical perspective, my preferred view suggests that this is going to be wave 4 as a triangle or wave 4 is complete, and that we are going to see crude oil maintain the ABC correction, which we discussed last month. But perhaps RSI and volume confirmations in this instance are false, and the more significant development may in fact prove to be the fade in momentum currently being demonstrated on the monthly RRG. So that's it from me. I hope you guys enjoyed the update. We'll be back Wednesday for our live stream, and tomorrow morning that is, and we will be back on Thursday to bring you an update again across the board in the major U.S. market indexes. Check us out anytime at tradinganalysis.com. If you did enjoy the content, please subscribe with notifications, give it a thumbs up, comment, and we'll see you on the next video. Take care.